Hi, how is everybody? I hope you're all doing well and going fine in the semester so far. Today I want to talk about something that's very important to analysis of any sort of new idea or an existing company, projections, etc., and that's the profit and loss statement. I imagine that many of you, from my experience at FIU, in the MBA program, and even in the business program, people are largely, some people are familiar, but some people are kind of unfamiliar with some of the key elements of the profit and loss statement, the balance sheet, cash flow statements, etc. I'm not going to go into it in huge detail. However, it is important to understand the fundamentals of these things, and hopefully you pick up more in other classes that deal with that directly, or you read on the side. Many of you might be like myself. I was a psychology major in undergraduate school, so I really had no business courses at all other until I got into grad school, and it was quite new and really different, and yet something. And other people catch up to some people who were business majors. Business majors are quite common these days, so you'll see a lot of people. Many of you maybe have done undergraduate in business, and then you continue on an MBA, which is hopefully not repetitive, but you should have that. But other people won't, and that's good. I mean, you should have if you're going to MBA school, then logically you would have done something different in undergrad. Anyway, today I want to just go briefly over this at something at a high level, so be really clear on what a P&L statement is and how to basically use it to analyze your company or to do projections, etc. Please look at the PowerPoint for this. It helps as you go along. And just look at the slide, second slide, really, the first one, writing on it. Basically, the profit and loss statement, as it says there, represents the flow of business activity for a particular accounting period, usually a month, a quarter, a year. You usually have a P&L statement that covers the fiscal year. And usually it's the same as the annual year, but some companies, for whatever reason, they'll say our fiscal year is June to June, etc. So you're basically looking at the revenue and all the expense items and getting down, and the point is to show what net income is. But along the way, you're showing how that net income is derived. What are the components of net income? And we'll look at that quickly, but you see the difference there is you're really trying to say this is, you might even look at your own life and say at the end of the year, what happened? How much money did I make? How much money did I spend? What did I spend it on? And what do I have left? And that would be your net income for the year, hopefully positive. But the profit and loss statement, you'll also hear it called income statement or maybe the earnings statement. And you're really trying to reach, like I said, the bottom line, which is net income. But also helps you show the different types of income. And every company, not so much every company, but every industry and category will have a different components of what makes up net income because of the kind of company they are. For example, if a restaurant's going to have a high level of costs associated with obtaining food to sell. Same with a grocery store, where other places that might be purely technology oriented, the sales are high. There isn't really that much they bought except for the PCs, etc. But it's what they think about and what they do and their marketing efforts, etc. that create, and their salaries might create the costs. So every industry will be different. Large retail stores, you'll look at things like what are they paying in rent for the per square foot location that they have, if it's an attractive mall, etc. So they'll be different, but that's really kind of the way it goes. So let's look at the next slide there. The P&L is often considered maybe more like a movie because it's showing what happened during the whole year. It's kind of it's a flow of business over the year. What happened over this last month? What happened over the quarter? What happened over the year? And you can see all the elements there. You might be familiar with what a balance sheet is. A balance sheet is much different from a PL. The balance sheet is a snapshot, is a one moment picture of where the company is at that exact date. So it can be completely different the next day. The P&L isn't. Being a P&L, unless you have one big item that comes in or a huge expense you're paid. But basically, if you look at a P&L over a series of years, you'll get a very good picture of how the income flows. Where the balance sheet won't tell you that. Balance sheet is easy to manipulate, easy to change, and it really just pictures that one day and time where it's set. So it can really be changed. A quick aside, it's quite simple to analyze the P&L. In other words, that you look at it and you say, well, there's the income, there are the expenses, and they paid taxes, and here's the bottom line. It's very difficult to analyze a balance sheet. It takes a lot of training, experience, and questioning to get behind the figures on a balance sheet. It looks very simple. You just look your assets, liabilities, etc., your net worth. But in reality, it's tricky. And you can even see when there's an old saying that if you're analysts and if your shareholders are asking about your P&L, fine. If they start asking about your balance sheet, that means they're concerned, because it's much more in depth to look at the balance sheet than it is the P&L. And for a lot of reasons, we won't talk about the balance sheet too much in this today or in this class, really. But it's fascinating, the balance sheet, what you can do with that, and timing of the different things that you report and how they're reported. Anyway, back to the P&L. So just I want you really to take away from this is a P&L is a financial statement. It summarizes revenues, costs, etc. over a certain period. That most companies, if you're publicly traded, if you have shares on the stock exchange, if you have investors, you must do a balance sheet, a P&L, and a cash flow statement. The cash flow statement, just really quickly, is just basically cash in, cash out. It's very important. Cash flow it's vitally important because it tells how much cash you have to pay your obligation. You may, on a balance sheet or even a P&L, look like you have a lot of money, but in reality you don't, because you're in your bank, there isn't any money to make certain payments that are due a certain day. That's what the cash flow statement talks. Are you able to, with the cash coming in, pay your obligations as they come in? You've all felt that in your lives. You might be paid $1,000 a month, but you don't get paid till next Tuesday, and you have to pay your rent today. So that's a cash flow problem. You have the money, you're going to get the money on your P&L to show that you have income and expense, but in reality today, your cash flow is suffering. That's what a cash flow statement shows. Anyway, you want to compare the P&L for different accounting periods. The changes in revenue, the changes are important. Whenever you're analyzing a company, look at the change. Look at whether it's the P&L, the cash flow statement, or the balance sheet. If you look at different years, what's different, what changed? And you need to find out why that is. What's the explanation for that? If something went way up, something went way down, something changed, a key element of revenue isn't there next year, that revenue that you didn't see 2 years ago, now it's a big one. What happened? What are they doing? It can be very good, it can be very bad, it can be just normal change in businesses. But whenever you see change, you have to ask what it is. And find out what that means, because it's the changes in revenue, the changes in cost. Those are things that show the strategy that the company is looking for. If they're being successful, unsuccessful, if they're innovating, if they're changing, if they're adjusting, adapting, capturing new market share, losing market share, etc., will be reflected in the changes of those three statements. Okay, for just to carry on there a bit, for nonprofits, revenue and expense are tracked differently because they don't need to. They're not regulated by authorities because of their people own their shares in the stock market to produce all the same things that a publicly held company would have to do, and sometimes and charitable organizations may have a completely different way of looking at it, because they're just really saying, where are our donations, how are we putting the money out, etc. So we're really talking about here major corporations or publicly traded, or and a P&L you should do for any size company, even if you don't need to report it to the authorities, or you need to know that for yourself. Okay, this is a very simple P&L, and you'll hear people say, what's the top line? Well, there's the top line right up there, and you'll say, what's the bottom line? Well, there's the bottom line. The top line is your gross revenues. What that means is that whatever you're selling, how much people pay for it, and how much comes into your company. You usually have interest income there as well. Not all, but usually you will. The bottom line is what you're left with, your net income. So top line is all the money in, and think about yourself. You might have you might work, you might sell some stuff on eBay, you might have a yard sale, you might get an inheritance from your grandfather, something like that. That all goes into the top. That's the top line. Makes sense, right? It all goes into the top. Everything you get goes in there. Then you go through the expenses. So what are the expenses in a company? You have all sorts of things. You have advertising, fees, book, all the things that are there. these are categories that you'll almost always have, but you may have other ones based on the type of company that you have. So again, very specific to your company. It might be research and development. If you're a pharmaceutical company, maybe a gigantic number that is completely not there if you're selling, shoes or something. The people that sell the shoes to the retail store, they have R&D, they have other things, but a retailer won't have that because it doesn't figure into their expenses. They'll have other things. So these are the sort of things that you'll see. Rent's always important. Materials, don't forget rent. Telephone, utilities, the other things, insurance, all sorts of things that need to be paid for a company to stay in business. And it's important to understand there are a whole bunch of costs. It's like when you first get your own apartment and stuff, you think, wow, I didn't realize there were so many things to pay. And there are. So it's just like that in a company. You have the top line, again, which is all the money in, then the expenses, and you get total expenses. Gross revenue, top line minus total expenses equals your operating income. Operating income, think of that word, operating. That means the money that you have from your normal operations, the money coming in, the money going out, leaves you the number. And then you have taxes. And corporate taxes right now are 21%. Of course, the current administration is considering increasing that, and it was almost as high as 40% prior to the 2017 tax reform. So this number, the tax number, reflects the current corporate tax based on the law for corporations. Right now, it's like 21%. I rounded it to 20 there, make it easy. It's very important, that number, because that affects your net income. When it's up at 40%, you make 100 and you keep 60. When it's 20, you make 100, you keep 80. And what do the companies do with that? They either hire more people, invest more, or they don't. Obviously, the higher the tax rate for corporations, the less people they hire, the less investment they can make, the less they can grow. And the lower, the more they're encouraged to hire people, grow, expand business, and do more things. So it's important to whatever your political views may be on what corporations should or shouldn't pay, that has a huge impact on what the strategy and going forward, because it affects the bottom line. Here's a more robust P&L for like a major corporation. These are in these are in thousands, so that top line there is 52 million rather than 52,000. So you just add three zeros on there. This way you would look at someone who's like a major, like maybe a tractor manufacturer or something like that. And you see their sales of machinery, energy, and transportation are their big number. And here's 1 year to the next. You can see there's not that much change as they go, because it's kind of a consistent company. That tells you a lot as well. You can see the total sales and revenue about the same. That means it's probably a more mature business. It's big. $55 million a year is good. The cost of goods sold, again, is relatively stable. So that shows whatever the materials they're buying are fairly consistent, and their margin, therefore, between what they're selling and what they're paying for their good are about the same. So you see what their expenses are. And here you see an example of a probably a mature company in a mature industry. They know what they're doing. It's highly predictable, and they seem to have their P&L managed. They're managing their business. They know what it is. If you ask them what the next year would be, they would say it's going to be 5% different from this or something like that, unless they're going to do something radically different. So this is a stable, large company, and your view would be, if you were to want to acquire this company, you'd say, all right, I get it. They understand what they're doing. How am I looking at if you work your way down there, how am I seeing the net income? Is that worth, if I multiply that over X amount of years, is that worth my investment in my purchase price of this company? Pretty simple to figure that out. So if you look through this, again, you're going down to 52, say you look at the column all the way to the right, they make 52.7 million, and then when they add that, the other revenues, their top line is $55.7 million. Then they start working their way down on expenses, and they see you go down to the total operating cost of $50 million. That leaves an operating profit, big picture, gross top line minus the expenses, of $5.6 million. So that's their operating margin, the difference between what they take in and what they have to pay on the normal operating business. Then they start deducting additional expenses. and there might be interest expenses. Sometimes it's a one-off here, like they sell the division or they buy something and you stick it in there. And they get down to, that all falls into other income, other expense. And then they get the consolidated profit prior to taxes, 5.128 million. You see that there? And then you get a provision for taxes, and so that comes down, so they pay their taxes and they get the profit consolidated companies, and that's it. So they get, their net income is $3.8 million. And then they have other things that they, little, sort of adjustments they make, and other things to describe their per share earnings, etc. But it's the same thing, it's just a little more complex and bigger. But basically the same. Top line, cost equal operating profit, minus other expenses equal, your profit before taxes. Then you subtract your taxes and you have your net income. Okay, so I hope that makes sense to you all. I think that's clear. I hope it's clear. Look at the write-up on that as well, and anything else you might want to see, and of course ask any questions. But it's important for you to be able to at least understand. And one thing I found when I doing other projects with students from FIU before is that they have a trouble with the top line. The top line, in a way, is quite simple. It's just like, what are you selling times how much you're selling it for. Like if your top line in a sandwich shop is, we charge an average of $9 for a sandwich. We sold 5,024 of them this month. 5,024 times 9 equals your top line, right? So it's the simplest way to think of it is like, what is my per unit cost times how many I'm going to sell? That's my top line. And then there might be little things like interest income, etc. But fundamentally, it's what am I selling? How much am I selling it for? How many am I going to sell? How many did I sell? Multiply that, and that's your top line. And everything works from there. Okay? So I hope that makes sense. Look forward to the next one, and I hope that, and again, if you have any questions on that, please let me know, and we'll cover it more in depth. Thanks a lot. Talk to you soon. Bye.